Welcome back, traders. It's going to be a big week of central bank meetings. The Fed, the Bank of Japan, and the Bank of England are all deciding their interest rates this week. And of course, the focus will be on the key call between the US and Russian presidents this Tuesday. It's going to be interesting to see whether the two leaders will finally lead to a ceasefire in Ukraine. But let's now zoom into the central bank events and let's break down euro dollar, dollar yen, and pound dollar, as those pairs may face relatively a strong volatility coming from those central bank events. And starting first with euro dollar and the Fed, the Fed is expected to keep interest rates steady. It has already reduced interest rates by 1% in 2024. And since then, it has shifted to the sidelines. It has adopted a data-dependent approach. And given all this uncertainty around Trump's trade policy, it's quite challenging for the central bank to decide its next policy decision, or better to say, to cut interest rates further, as signs of economic weakness are showing up. There was a slowdown in inflation and in hiring during the month of February. So investors believe that partially have translated these signals as a sign of economic weakness. So the Fed may face a very challenging press conference as investors would like to know what's the central bank's economic outlook and how the latest developments have affected its economic projections. So if the Fed sounds relatively more hawkish, if it sounds more optimistic about the economy than analysts are currently, then that could bring some weakness in euro dollar. It could help the US dollar to gain some strength, so that could affect negatively. That could add some pressure on euro dollar, which is currently trying to reach last week's high at 1.0946. If we successfully break this high, and I would also like to see clear move above the 1.10 level, then in this case, the pair could face a significant appreciation towards the 1.1175 and 1.12 territory, where this resistance line coming from the 2021 high is located. So that would be a huge development, a huge milestone for euro dollar. Now looking at the technical indicators, we can see that the RSI is already still hovering around the 70 overbought level. The MACD has also stabilized, and the stochastics, although it's trying to rebound, it's still on a downward trajectory. So I would rule out some consolidation or perhaps a negative correction. And if the 1.0865 level fails to hold, then the next support could emerge somewhere between 1.0765 and 1.08. Then, the 61.8% Fibonacci retracement of this downleg is also within this region, so that adds some extra importance to this territory, a break of which could take us down towards the 200-day moving average at 1.0660, where slightly lower the 20 and 50-day moving averages could also protect the market near 1.0620. Now looking at dollar yen, the Bank of Japan is also expected to keep interest rates steady at 0.5%. Markets have been pricing another rate hike this year, and the central bank has been using a hawkish communication, especially after the latest wage talks have suggested that there might be more wage increases in the year ahead. So the central bank may have more reason to hike interest rates, but the trade uncertainty, as Japan wasn't an exception of the Trump's international aluminum and steel tariffs. Those trade risks could still affect sentiment and could keep the central bank on the sidelines for another meeting. So if the Bank of Japan uses a more neutral tone, if it doesn't sound very hawkish, that could help dollar yen to continue higher. But from a technical perspective, we can see that the pair is already near a key resistance territory. It's currently testing its 20-day exponential moving average near 149.25, while slightly higher than that, the 150 mark, and the upper bound of this bearish channel could also be another barrier before the price targets higher levels, and particularly its 50 and 200-day EMAs, which have already posted a death cross, signaling further deterioration in this bearish trend over here. Now, well, if we look at the technical indicators, well, we can see some improvement. The RSI has reversed to the upside. The stochastics are also trending up, but the RSI has yet to cross above 50. So the bias is still not on the bullish side. And if the 149.25 region proves a tough obstacle, that pair could reverse lower to test its 147, 146.50 support territory. Failure to hold here could then confirm additional losses towards the lower band of this bearish channel, seen around 145.45. And finally, looking at pound dollar, well, the Bank of England is not expected to change its interest rates either. Last week's GDP growth data have surprisingly slowed down, so that adds that somewhat dampen hopes for the economy. Nevertheless, trade risks and the risk of an inflation resurgence after the UK was also targeted by the Trump's universal steel and aluminum tariffs that could keep policymakers on the sidelines for the time being. Well, Trump's policy is very unpredictable, so it's very difficult for policymakers to decide clearly about their next policy decisions. And the Bank of England has been relatively more careful with cutting interest rates. It has been cutting interest rates once per quarter, more or less. So we don't expect the central bank to make a move this time either. But we do have new economic projections, so those could still move pound dollar. And looking at the chart, if the central bank sounds more optimistic about the economy, we could see a bullish continuation, perhaps towards this resistance trend line near 1.3065, while slightly higher than that, the 2023 high of 1.3140 could be another key obstacle before we head towards the next barrier seen around 1.3265. Well, if we look at the technical indicators, however, we can see some signs of a weakness. The RSI has been moving sideways around its 70 overbought mark for a couple of sessions. The stochastic oscillator is already trending down, and the MACD has stabilized and is set to cross below its red signal line. So all this suggests or reflect signs of caution, and if the pair fails to continue higher, instead closes below the 61.8% Fibonacci retracement of this down leg over here at 1.2923, which is currently supporting the market, then we could see more declines, particularly if the 1.2875 floor breaks as well. Then the 20 and 200-day moving averages could also be in focus somewhere between 1.27 and 90. Lower than that, the support trend line could come into view around 1.2730 if selling pressures continue. And if we fail to hold here, then a steeper decline towards 1.26 and perhaps closer to the 50-day moving average at 1.2565 could be also the next destination. So that's everything I wanted to share with you guys. I hope you liked my video. Please subscribe if you liked my analysis. I will be back soon for more technical analysis. Thank you for watching and see you next time. Bye bye for now.